Welcome to episode 9 of All About Debt Funds, a 10-episode series by Bajaj Finserv Mutual Fund. Today, we're going to talk about the risk in debt fund investing. Just like any other investment instrument, debt funds come with their own set of risks that you need to be aware about. Understanding these risks and knowing how to manage them is the key to making suitable investment decisions. So let's break down what these risks are and how you can handle them effectively. Managing a debt fund is like checking the weather before you head out for the day. Some days the forecast is clear and sunny, with a little risk of unexpected changes. Other days, however, there might be clouds on the horizon, suggesting the potential for rain or a storm. Similarly, debt funds carry risks such as credit risk and interest rate risk. These risks can fluctuate and affect the value of your investments. Just like the weather, these risks are unpredictable, and the key to managing them is diversification. This ensures that no matter what happens, you're prepared. Understanding credit risk and interest rate risk. Credit risk is like the chance of a sudden storm appearing. Sometimes a borrower may not be able to repay the debt, which can cause an investment to lose value. This is like how unexpected storms can catch you off guard when you're not prepared. Interest rate risk, on the other hand, is more like a shift in the weather patterns over time. If interest rates rise, it can cause the value of the bonds to fall. Like a change in weather may require you to adjust your plans. Interest rate fluctuations can impact your debt fund's performance, making it important to monitor these shifts regularly. Similarly, when you invest in debt funds, you're trusting the bond issuer to repay the loan. But just like the unpredictable weather, some bonds carry a higher risk. Bonds with lower credit rating are like unreliable weather forecasts. You can't always be sure what to expect. Next, let's talk about interest rate risk. Think about how weather can change unexpectedly through the day. When interest rates rise, the value of existing bonds is likely to fall because newer bonds offer better rates. When interest rates fall, although it's not very common, older bonds with higher rates become more suitable. Just like how weather can change suddenly, interest rate changes can affect your investments. Diversification as a risk management tool. Just like preparing for different weather conditions by dressing accordingly or carrying various gear, debt funds invest in a mix of bonds with different credit ratings, maturities, and sensitivities to interest rates. This diversification helps balance risk, ensuring that if one bond underperforms, the rest of the portfolio can still perform well. Much like how multiple outfits or gear can keep you prepared for any weather change. For example, some bonds may be less affected by interest rate changes, while others offer higher returns potential but come with relatively more risk. If one bond type struggles, others may perform well, helping maintain the overall stability of your investment. Just like having a variety of gear to handle different conditions, diversification protects your portfolio from unexpected shifts in the market, making it more resilient to economic changes. Quick fact: the two main risks in debt fund investing are credit risk and interest rate risk. Diversifying your investments helps minimize the impact of these risks, ensuring you're prepared for any change, much like how you dress for different weather conditions. Task for viewers: think about the last time you were prepared for an unexpected change in the weather. Maybe it was a sudden rainstorm on an unexpected cold day. How did you manage it? Did you grab an umbrella or change your plans? Reflect on how you made those decisions. What factors did you consider and how did you stay prepared? Now, take the same approach with your investments. Just like the weather, investments require you to anticipate risk and plan accordingly. Consider your goals and resources, what risks are worth taking, and where do you want to be more conscious. Bonus insight: while risk is inherent in any investment, debt funds tend to carry relatively lower risk than equity investments. However, managing those risks through diversification is the key. Just as preparing for all different types of weathers ensures you're covered, diversifying your debt fund investments ensures you're protected. no matter what risk comes your way. In our final episode, we'll dive into innovations in debt funds, new strategies and products that make investing more flexible and exciting. Stay tuned for episode 10.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.